What up, guys? Welcome back to another video, and it's your boy J Manchin, of course. And today we're going to be talking about the Moody's downgrade of U.S. debt, as well as why I think the Federal Reserve is in a great position to cut rates right now. Let's get into the video. So, Moody's, which is one of the main bond credit ratings agencies, has downgraded America U.S. debt from AAA to AA1.
Moody is lowering its credit rating on the United States debt one notch to AA from AAA due to increasing government debt and interest payments.
And they cited the U.S. debt/deficit as the main issue going forward. So they wrote, successive U.S. administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits and growing interest costs. We do not believe that material multi-year reductions in mandatory spending and deficits will result from current fiscal proposals under consideration. Over the next decade, we expect larger deficits as entitlement spending rises while government revenue remains broadly flat. In turn, persistent large fiscal deficits will drive the government's debt and interest burden higher. The U.S. fiscal performance is likely to deteriorate relative to its own past and compared to other highly rated sovereigns. So a while ago, I made a video on why the fiscal deficit is now a permanent fixture of the U.S. economic foundation. And they're basically agreeing with that. And they also took a shot at Doge and Elon Musk by saying that we do not believe that material multi-year reductions in mandatory spending and deficits will result from current fiscal proposals under consideration, i.e. Doge. In reading through that press release, I get an implication of an anticipation of a credit crisis if we remain on the same path. And a credit crisis, guys, you can look at, 2008, for example. It always starts with a trigger. And in 2008, the trigger was the subprime mortgage market blowing up. And so when that blew up, the last buyers, they were stuck with shitty assets. To get out of those money-losing positions, they have to borrow more money to be able to allocate elsewhere. And because their credit ratings as a corporation was lowered by their lending partners or institutions, the well dried up on them as well, which caused a pullback on lending, which means there's less productive economic activity, which means it eventually spirals into a full-blown recession. Now, they're expecting the debt to GDP ratio to hit 134% in 2035, which was 98% in 2024. They're also expecting the deficit as a percentage to GDP to hit 9% by 2035, and that was 6.4 in 2024. And they're also expecting the interest expense to reach 30% of total spending by 2035, which is 18% in 2024, which are crazy numbers. But I do believe because having a deficit and running off of a deficit is it's just in our nature. It's literally in our blood. It's almost like if credit is our blood. So, imagine if you just lost all your blood. It wouldn't be a you. And then you got trade deals happening where, the Middle East is going to invest $3 trillion over the next decade, basically placing a bet on U.S. debt long term. So I don't think the deficit itself will be a catalyst for a full-blown credit crisis. So I looked at that press release as more of something to look out for, or an almost warning, not an actual warning, but like an almost warning. A warning that the current fiscal path that we are on under the current administration is not a sustainable one, and that the deficit is at risk of rapidly rising where we are now. But to be honest, it doesn't matter who rates what. All that matters really is how this data actually feeds into the real economy eventually. Moving on to the Fed. Now, there have been split debates on whether the Fed should cut rates sooner or later. And before, I was in the camp that the Fed has been on the right track, holding when they're holding, cutting when they're cutting, raising when they're raising. The last few years, I've agreed with pretty much everything the Fed has done, even though there's been disagreements on every decision he makes, but there's always going to be disagreements. Now, I do think the Fed is in a great position to cut rates and be preemptive versus reactive. And the reason is because, look, man, they beat inflation. Inflation is running lower than expected. And we haven't had a huge spike, and we haven't seen crazy impacts from tariffs yet either. I mean, core CPI is at 2.8%. Core PCE is at 2.6%. Core PPI is at 2.9%. And truflation is at 1.85%, or at least the last time I checked like a day ago. And the labor market is still at full employment. The unemployment rate set still at 4.2%. And full employment is technically anywhere between 4 and 5% unemployment. And as I have been saying for the past year, there are no signs of softening in the labor market. And Jerome Powell said himself, just because we got a little tightened in the labor market, that wouldn't warrant a policy move i.e. it wouldn't make us cut rates because we saw a little bit of softening in the labor market.
We also concluded that policy decisions would be informed by assessments of shortfalls rather than deviations from maximum employment. The change to shortfalls was not a commitment to permanently forswear preemption or to ignore labor market tightness. Rather, it signaled that apparent labor market tightness would not, in isolation, be enough to trigger a policy response, unless the committee believed that, if left unchecked, it would lead to unwelcome inflationary pressure.
Now, Jerome Powell also validated my sentiment that I think that they should move earlier by saying this.
Reflecting these concerns, we adopted a policy to make up for persistent shortfalls from the inflation target, an approach that was common in the extensive literature on the risks associated with the lower bound. Given the downside risks to employment and inflation from proximity to the lower bound, and the need to anchor longer-term inflation expectations at 2%, we said that following periods in which inflation has been running persistently below 2%, we would likely aim to achieve inflation moderately above 2% for some time.
Now, to put that in English, what he's referring to is what you would call flexible inflation targeting. The last time we did this was in 2020. And so you can look at it like this. If inflation, obviously super simplified, let's say this line is 2% inflation. What the Fed is referring to is allowing inflation to go slightly above or slightly below for a period of time, because long term, the hope is that inflation balances out at 2%. Now, he's saying one or two things in that statement. He's either saying that we'd be open to being preemptive and cutting sooner than we thought even, or he's saying in the event that we have a good amount of tariff inflation, that wouldn't cause him to feel the need to want to raise rates to try to tame inflation. He would allow it to stay elevated above 2% for a period of time. And in his case, he wouldn't have to adjust policy or interest rates in that case. Now, of course, those two risks as a part of the dual mandate still remains: cutting rates too soon and reigniting inflation, and keeping rates where they are too long in this restrictive territory, and it puts pressure on the labor market. But he's expressed that he's not really too worried about the labor market, and that even if we saw some tightening in the labor market, it wouldn't warrant a policy reaction. Look, at this point, I think it really is a good place to lower interest rates if they were going to do so. I think a 25 basis point cut will be appropriate at the next meeting in June. And that's barring any crazy news on tariffs, of course. And the market is pricing in a 95% chance that the Fed will hold rates steady at their June meeting. And I agree with the sentiment, because historically, at least in recent history, the Fed is supposed to be preemptive, but they've been reactive and not preemptive. And so if we had to make a bet on being preemptive or being reactive for the Fed, I will put my money on them being reactive as well. And because we're at full employment, I think it's really a safe place to do so. So Fed funds rate projections show that they want to get down to 3.9% by the end of 2025, which means with 5 meetings left in the year, that gives you have to cut 2 more times in 5 meetings, right? And so they have a little bit of ammo to do so. That's assuming a 25 basis point cut each meeting, by the way. I remember about, I think it was a year and a half ago, we were talking about on this channel how the Fed kept the optionality open. This is what I meant. And so now, because you have 5 meetings left, you want to get down to the target range of 3.9 on the Fed funds rate. You have optionality. You have 5 more meetings to potentially cut 2 more times at 25 basis points. That's pretty good optionality. In the face of uncertainty, it was a prudent decision to create such optionality. But still, I think they should get ahead of the curve and cut at the June meeting. But we all know Jay Powell would rather put out the fire after it starts versus prevent the fire in the first place. And all in all, of course, I think Jay Powell has done a fantastic job at the chair of the Federal Reserve. And at the end of the day, it's a reason that he's the Federal Reserve Chairman and not me. Thank you for watching.